Hi, everybody. Welcome to today's Solution Spotlight. Just going to give it a couple more ticks before we really get started. But yeah. Ben, any fun holiday plans coming up?
There are holidays coming up.
Yeah, no, I didn't.
Uh, fun? I don't know. It depends. What's your definition of fun, Sarah? Family? Is family fun? For some people, family is fun.
I think family is fun. I love hanging out with my parents.
Yeah.
But what about you?
Um, uh, we will be spending a loud Thanksgiving because there will be multiple family people who are coming home from college. It's their first year in college, so there's various cousins and various things like that. So it will be a little bit of a reunion and a little bit of a, come home, get some TLC before we send you back from whence you came. Because you don't have to go home, but you can't stay here as the
Oh yeah.
you know. Do you have anything fun planned?
My parents are coming to visit, so just a low-key Thanksgiving with them. I'm sure that we'll brine some turkey. It'll be my first time cooking Thanksgiving dinner, so
Piece of
fingers
cake.
crossed for
Yeah.
us.
Are you deep frying everything? The answer, I'm guessing no. I'm guessing no.
EBD, I should figure out the menu, but another day. Okay, sweet. Well, everybody is here, so let's get started. Welcome again to today's Solution Spotlight, your year-end tax planning playbook. My name is Sarah Williams. I am XYPN's Senior Partnerships Operations Manager, and joining me today is Ben Birkin, CFP and Vice President of Customer Success and Engagement at Holistiplan. Now, as the year end approaches, we know you may be laser focused on finding those last minute tax planning strategies and just wins for your clients. And today, Ben will share the top 5 tax planning strategies to review with every client before year end. Also, this webinar has been accepted by the CFP board for one CFP credit, CE credit. So, to receive that CE credit, you must attend the webinar for at least 50 minutes and you should have provided your CFP ID number during the registration. If you haven't, then email membership at xyplanningnetwork.com and we'll get you all taken care of there. But before I turn it over to Ben, just a couple of housekeeping items. We are going to have some time for Q&A, so as questions come up, there is that Q&A tab that's at the bottom of that toolbar of your Zoom screen. Please feel free to drop them throughout the presentation. We'll get to them afterwards or after the presentation kind of just wraps. Um, but please don't hesitate to drop them in. And then we have a couple of XYPN webinars coming up. So on November 19th, XYPN Learn to Launch office hours are happening. And then on December 10th, another event is happening, planning your big move in 2026, transitioning from a BD to fee only corporate REA. And I will drop both of those registration links in the chat. And last but not least, XYPN Live, our favorite time of year, is headed to San Diego, one of my favorite places personally. And that's happening in September of 2026. Grab your pass, and that link is going to be in the chat as well. Alrighty, Ben, I am going to turn it over to you. It is yours.
Thank you, Sarah. For anybody who is not sure whether or not they want to go to San Diego, you should really go. And I say that as I'm originally from Los Angeles, so like San Diego is on my uh, not so happy list. I'm a big baseball fan, big Dodgers fan, and the San Diego Padres and the Dodgers have had a little bit of a rivalry going on. But if you haven't been to San Diego, it's probably like one of the nicest places to go in the world. The weather's always beautiful, the water's right there. So I encourage everybody to go. Okay, putting that commercial aside, it's nice to see everybody. For those of you who are already Holistiplan users, some of the stuff that we're going to talk about today, you might have already seen because it's stuff that the CEO, Roger Pine, and I discussed in one of our quarterly keynote addresses in September. But what we're going to talk about today, I know Sarah teed it up as, hey, here are the 5 tax planning things you got to do by the end of the year. And that's true. We will talk about those things, but I'm going to give a little bit of a disclaimer. If you are afraid that we are going to go like way deep into the tax code, fear not, right? We're not going to do that today. Today, we'll talk a little bit about some technical stuff, but we're really going to zoom out a little bit and think more high level process type stuff. And there's a good reason for that. Um, when we think about internally at Holistiplan, what's our busiest time? And, Sarah mentioned my title is the VP of customer. I think it's customer success and engagement. It's also like VP of support. So I run and oversee the team of people who receive the inbound tickets, right? So it's Holistiplan users who are asking us, how do I do this? How do I do that? Um, the fourth quarter is actually our highest traffic part of the year. It's our highest volume of the year. It's not April and May, which you would think because that's when people are getting, for the most part, their tax returns back and uploading them to Holistiplan and getting their tax report. Our highest volume ticket count is always the fourth quarter of every year. And why? Well, it's because tax planning, amongst all the things that we do in the comprehensive financial planning process, it's one of the handful, if not the only one, where you have to get stuff done by December 31st, right? There are a couple of exceptions for where that's not always true. Um, but for the most part, things kind of have to be done by the end of the year to count for this year from a tax planning point of view. And so we joke, why are we getting the highest volume of stuff in the fourth quarter? It's because people kind of woke up in October and realized, oh, snap, there's only 3 more months of the year. I should really think about how I'm going to do these tax planning things for their clients. Now, so estate and insurance and investments, obviously investments, we're looking at stuff all over the course of the year, but there's anything that like critical has to be done by the end of the year. I don't know, maybe not, but whatever has to be done by the end of the year probably has tax implications anyway. Should we be looking at stuff related to estate and insurance over the course of the year? Uh, we probably should be looking, but it's unlikely that you're going to be taking action every year. That's different than tax, right? Tax, you probably are looking every year, and there's probably some action that you are taking every year. So it stands out as this unique thing within the financial planning process where that December 31st deadline is kind of important. Um, now I'm going to pose this. I realized I think the chat's disabled for most folks, but maybe there's a raise of hands in the little participant thing just to give me a sense here. How many of you do a full tax planning workup for all of your clients every year? And just like raise your hand in the little, you can raise your hand at your desk too if you want, but I can't see that. So that's not really going to count. All right, there are 111 people here and I see five, seven. Okay, we're starting to get there. Okay, six, I don't know, six, seven. So what I'm seeing though is like it's not 112, right? 112 of you are not doing tax planning, a full tax workup for all of your clients every year. That is not uncommon. Maybe you are one of the handfuls of people that do that, but most don't. How do we know that? Well, we ask our users. We ask our users, how many of you are using Holistiplan or doing tax planning um, over the course of the year for everybody? And most of them, when we talk to them at conferences or when we have these calls with people, they say, well, I do it for like my highest level clients, my top 10% of my clients, maybe my top 20% of my clients, but I don't do it by everybody. And we also know that even non-anecdotally, when you have to list the number of clients you have in your ADV. And so we can look at our users' ADVs and then look and see, well, how many households do you have in the system? And there's not a one-to-one match. In fact, it's much less than that. When we do that, roughly what we see is maybe about 25% of the clients served by advisors, according to their ADV, are even in the Holistiplan database. And the reality is that it's only a subset of that are getting like end of year tax planning type stuff. And when we ask folks, we're curious. Obviously, we have a vested interest in more people getting tax planning is kind of what we're here for. But we ask why. And the answers that we get are, at least to us, and I say us, yes, I'm here as a representative of Holistiplan, but for those of you who are familiar with Holistiplan and or with me, I'm still a practicing advisor. I run a small RIA. I'm an XY member. And so I still work with about 10 clients. And so it's always a little strange to me when we hear the following reasons why. The first one, which is the one that really hurts, is not everybody needs tax planning. We strongly disagree, right? All of your clients need some form of tax planning. Again, is one of the few areas you can add value every year in some fashion. Um, Second reason is we don't have enough people in the firm who know taxes. You know, Different people can agree as to whether or not that's a valid reason. Like, should you know taxes? I would argue if you're a comprehensive financial planner and you don't know taxes, like that's kind of a problem. But I can also appreciate too, especially folks maybe early in their financial planning advisory career, you don't have that comfort level where you might believe you need to know all the intricacies of the tax code. I don't know, would it be helpful? Absolutely. But do you need to know every single thing about bonus depreciation for business and business equipment? I would argue probably not, right? There's some level of tax planning that you kind of need to know, but you don't need to be a CPA and 10 years of tax experience to deliver quality financial planning, quality tax planning to your clients. And then the third one, which is actually what we're going to talk about today, is we can't fit in the extra work. We don't have the processes to help facilitate good year-end, full year tax planning for everybody. And that's actually what we're going to talk about today, because we argue, that's probably the better driving force as to why people don't do it, because they haven't figured out how. It's not that they don't want to, maybe. It's not that they don't necessarily feel competent. Again, there's some element of that that's true, but there's also an element of that that's like you don't need to be an expert to deliver good quality tax planning to folks. It's more from what we've seen, just the inability to wrap a process label, a process wrapper around what we're doing. Um, if your process is robust, you don't need a building full of tax experts, and you can fit the work in. There's time for it if the process makes best use of all the resources that you have. So if the process supports it, yes, you can do a review for everybody. Even if for some clients you don't have any like juicy opportunities, you can do a show your work. It's like, I looked at everything. You're doing everything right. There's value in that, right? There's value in that. If you upload a tax return to a Holistiplan and everything looks fine and you have nothing to add to a client situation, how valuable is that to your client for you to say, I'm your financial advisor. I'm looking at everything and you're knocking it out of the park. Um, that's huge. That is huge, especially in a world where taxes are complicated, opaque, people don't understand them. So if you can come back to somebody and say, you're actually doing everything you can do, you're doing it great. You might not like how much you're paying, but you're doing everything right. There's a value add to that. And so today, what we're going to talk about is process. So putting together an entry level end of year process. Yes, we're going to talk about those 5 things that Sarah mentioned, because that's kind of the big deal when we think about this process, what those 5 things are. So we're going to talk about what you need to build, how do we do some of that end of year tax planning, how we track the process across your entire company. We're not going to do that deep technical dive into the corners of the tax code. So we're trying to keep things super simple. We'll dive in a little bit. So maybe just enough for the nerds to feel like they got something out of it, but we don't want this to be like a deep dive, in-depth view into the tax code. So the first thing that you need to do, and I'm going to share my screen, there's no PowerPoint for today. We are going to do all of the stuff by looking at the Holistiplan system and then, a particular spreadsheet that we put together for this very purpose. So hopefully everybody can see this. Sarah, can you confirm that you can see my screen okay?
Confirmed.
Awesome. Thank you. Okay. So the first thing that you need to do, this is going to sound super silly. You need to have a list of all your clients. Now, hopefully you're all Holistiplan users, but hopefully even if you're not, you have a CRM, something that tells you who all of your clients are. If you don't have that, that's step one. You got to get that. Now you can use our system to do what I'm about to describe. And in fact, what I'm going to show you, this is what I'm going to show you. It's going to be a spreadsheet that's got all of your clients. And then here are the 5 things we're going to talk about today. But you'll see there's a bunch of other stuff that's on here, right? The ages of the clients, their adjusted gross income, marginal brackets, all these things. This is all actually pulled from our system. So I'm inside of a demo household here. This is not a real firm, but when I go to the household screen for these people, you're going to see these are all fake people, right? None of these people actually exist. This is what that spreadsheet got pulled from, and I can do what I just described by downloading my household screen. And when I do that, I'm going to get an Excel spreadsheet or a CSV file. And it's going to have all these different columns that I've got here. This is why I think if we're thinking about doing this for, a process for tax planning, if you've got everybody inside of Holistiplan, particularly if you have uploaded returns for them, this becomes that much more powerful. So again, you're going to pull from the system that you've got, whether it's Holistiplan or whether it's Wealthbox or Redtail, whatever CRM that you're using, go ahead and do that and create that list. Step 2, right? We've created the list. We're going to decide as a company what we're going to do this year. Like, what are our big things? And so here, when we go back to our spreadsheet, you're going to see what those things are, right? We're going to talk about salary deferrals, right? Why is it important to talk about salary deferrals towards the end of the year? Well, we actually know now what the deferral amounts are going to be for next year, right? So we have 2 things going on. One, making sure for anybody who are doing maximum deferrals to various things this year that they're on track to do that. And then two, that they're set up for next year. We'll talk about this in more detail as we go through. Second thing might be charity, end of year charity, right? So things have to be done by the end of the year to count tax wise for 2025, right? It has to be done by by December 31st, 2025. Third thing, somewhat related, but not necessarily has to be related, required minimum distributions, right? So who do we need to be mindful of to make sure that we complete the required minimum distributions? There's a bunch of systems now that help you do this. For anybody who's using, certain CRMs, I think have this as a field. Other portfolio management softwares have this as a field. So again, trying to bring in who do I know I need to do RMDs for and get that done by the end of the year. Capital gains harvesting, again, has to be done by the end of the year to count. People are familiar with capital loss harvesting. We'll talk about that maybe a little bit, but we're going to focus more on capital gains harvesting because that's actually more of a fun story. Roth conversions have to be done by the end of the year. Happens to be the number one use case for a Holistiplan. We'll talk through that. And then maybe, I don't know, maybe you've got a grab bag. So I listed 5 things on here, right? 1, 2, 3, 4, 5. And then this grab bag, again, we might not talk about these things today, but are there any other special things that you might do for handfuls of clients? Like who's selling a business, who's got Schedule C stuff because they've got variable income that you want to be mindful of for estimated payments, right? So that's our grab bag. Um, then we need to use this spreadsheet, right? We've identified our things. Then we need to use something like this spreadsheet. We put this together. You can come up with something similar if you want to, but this is the idea here is um, which things in advance apply to which clients, right? So, you might know who your accumulators are, who you have to worry about who's still working. Right now, you'll see this color coded. I'll come back to this in just a minute. You can use Holistiplan natively for some of these things. Anything that is age related, if you've entered the ages for your clients in our system, we're going to populate these age-related milestones, like telling you who is eligible for a QCD based on their age, who needs to take a required minimum distribution based on their age, who is at their first required minimum distribution this year, right? So some of these things that are age-related, Holistic will actually populate those for you. Other things might not be things that Holistiplan would natively know, but that are important to you. And those are things that you can use tags for, right? So we've just tagged a handful of folks as being accumulators, really more for exhibiting purposes, so you can see what this looks like. But you can have tags beyond just accumulator. So we see people who use tags to indicate good Roth conversion candidate, tags to indicate charitable intent, right? Things that aren't necessarily going to be tied to their age, but are going to be important for you to know. Um, then we can go back and look at this spreadsheet and formulate it a little bit and say, okay, these are just if statements, right? So this says, if this particular cell says that there is a accumulator, right? We're going to color code that as 0 or 1. And so we're just using this. This is kind of a very quick way of doing it, but it's giving you this at a glance. Who are the people that I really need to pay attention to in terms of the strategies that I'm going to talk about so that I can focus? Again, this is process oriented, right? I'm not looking at one by one every single time. I'm going to do this concentrated process for who do I need to focus on for salary deferrals? Who do I need to focus on for charity, right? Then we would argue you probably want to have a kickoff meeting. It's a little towards the late side now, but at the beginning of the quarter, you'd want to have your kickoff meeting at your firm, identify what you're going to do, who you're going to do it for, train the team, and then hand out those assignments, right? So now we're going to go one by one with these 5 things: salary deferrals, charity, RMDs, cap gains harvesting, and Roth. We'll go one by one how you might think about doing this inside of Holistiplan. So the first one, like I said, salary deferrals. We know that the numbers, in fact, folks might have seen this already. It was either yesterday or today. We already have known what the 401k contribution limits are going to be for next year, not just the standard ones, but the catch up. But we also now have like the IRA amounts for contributions for next year. We also have HSA contribution amounts for next year, right? Things that are going to be coming out of that salary deferral side of things, right? Um, what we could then do is then say, like, who's maxing out, who do we know is maxing out, who's eligible for catch-ups that weren't before. So what's an example of that? Well, if we look at the Beard household right here, right, it says age 49. Why is that important? Well, if we hover over this little pillbox, it says one of the members, Jaden in this case, is 1 year away from the eligibility for catch-up contributions. Discuss changing any annual savings plans that might have been in steady state for a long time. What does that mean? Well, when you turn 50 with 401ks, 403bs, things like that, IRAs too, you not only get to defer the statutory amount that everybody does, but you can do an additional catch-up amount, right? So an additional catch-up amount. So this is just showing you and prepping you that for Jaden here, um, next year, so 2026, we need to be talking about what that's going to look like if the plan is to maximize the contributions to these salary deferral things. So if we jump into the Holistiplan right here, so this is Jaden and Casey. This left-hand scenario, this is 2025. This is their base case. This is what happened this year. If we click on the wages worksheet, we see the gross wages for both of them, as well as the pre-tax savings deferrals for both of them. We're just hypothetically saying that they both maxed out their 401k or their 403b. We know that Jaden next year has the ability to contribute more because he's going to be 50 in 2026. We can start modeling, okay, instead of 23,500, Jaden next year could maybe do 31,000, right? So that's an additional $7,500. We can start talking to Jaden and saying, and Casey, and saying, okay, if we model what this is going to look like by doing that additional amount of catch-up contributions that he's eligible to do, that's going to be a tax savings if we use a comparison tool between these two scenarios, saving an additional $7,500 of pre-tax money. Will end up netting about a $2,400 or so tax deduction, tax change from 2026 to 2025 to 2026. Embedded in that, by the way, this is something that I'm not sure how many folks are aware. Secure 2.0, if everybody remembers in the Wayback Machine, Secure 2.0, it talked about a few things, one of which had to do with catch-up contributions, right? Including when you're 60 and above, there's even like more catch-up opportunities, right? So an even greater amount for catch-up. The hitch is that if you make above a certain dollar amount, those catch-up contributions that you might have thought were going to go towards traditional plans have to go to Roth plans, right? That's part of the law. That's supposed to go into effect next year. Not every plan is set up to do this, but that's what they are supposed to have to do. So these are the kinds of conversations you can be having with people and saying, okay, next year you can contribute more to your plan, but it actually may or may not be tax deductible based on how much money you made last year, right? So these are the kinds of conversations you can start teeing up, but you have to do this by knowing, again, who your accumulators are, who is maxing out, who is not. So we would argue that while you can use the tags inside of here, that's a great start, but you can also use your CRMs to indicate who's maxing out. Maybe they get a reminder in mid-November now, right? When those new limits are out and known. Um, you might want to update your CRMs and send an email about people who are eligible for these catch-ups for the first time. And maybe that's a slightly different message, right? So maybe the folks who aren't going to be in that catch-up mode get one message. Again, it can be a templated message. It's, hey, just so you know, new maximum contributions are out. This is what you should be planning for. If you have to make an active change in your workplace system to do that, right? Some workplace retirement plans will allow you to always do the max no matter what it is. Some of them are more manual, right? So just giving your clients this heads up, hey, you don't have to do it today, but if the goal is to max out 2026, here's what you need to change your monthly or your biweekly contributions to make sure that you max out. Again, slightly different message for those folks who are going to be doing the catch up because they need to be aware if this is the plan, yeah, there's going to be more going into savings, but if you are anticipating the cash flow impact of that being one thing, you should tell them, right? They can have that heads up about it. And maybe people who aren't maxing out should get a reminder too. Maybe there's a third message that you say like, hey, I know you're not maxing out. I just want you to know this is something that I'm aware of and I'm giving you a heads up that things are changing a little bit next year. So maybe if the goal is to try to get them to max out, you've now prepped them for here's what we're trying to do next year or the year after than that, right? That's part of that process. Now, what we just talked about, do you need to be a tax expert to do it? No, you don't. Does it help to know a little bit about the rules related to some of these things and what the catch-ups are in that Secure 2.0? It helps, sure, but is it required to be a tax expert to do that? Absolutely not, right? So that's one of those five things. The second one that we were going to talk about was related to charity. So when we're thinking about charity, right, what does our checklist for charitable related things need to be? There's actually kind of two shoots, right? One that's going to apply to everybody, and the one that's only going to apply to a specific subset of people. The one that's going to apply to everybody would be people who are just making contributions, out of after-tax accounts. Maybe they're getting a deduction for it, maybe they're not, right? Because the standard deduction is so high, but knowing who is charitably inclined. doing those after-tax contributions. The second shoot would be people, A, who are charitably inclined, but B, who also are above age 70 and a half, or who will turn 70 and a half this year. And the reason why that age is important is because that's the age when you can start doing qualified charitable distributions, right? Where money comes directly out of your IRA to a charity. So it bypasses your checking account entirely. In doing so, you don't have to count it as income. You don't get a corresponding deduction for it on Schedule A, but it's because you don't have to count it as income. And, the coup de grace for most folks is that a QCD up to, I think this year it's a little over $100,000 can count towards your required minimum distribution, right? So three things: doesn't count as income, you don't get a deduction for it, but the fact that it doesn't count as income means that it's effectively like 100% tax deductible, right? Because you never have to claim the income. Um, because it never hits your tax return, it impacts your adjusted gross income. I should say it doesn't impact your adjusted gross income, right? Your AGI doesn't go up because you've taken an IRA distribution and then sent it back out to charity. That can be important because your AGI kind of determines your deductibility of certain things. And then again, it counts towards your required minimum distribution. So what might that look like? Well, let's jump into, the Alvarado household here. So here we've got, this is, instead of looking at next year, we're thinking about this year. So in this year, 2025, here's our baseline. These folks have, we're going to assume that these folks are both taking required minimum distributions. So Milan has a $40,000 RMD. Aofi has a $30,000 RMD. What would happen if we took some portion of that, and instead of having it be the full $40,000, maybe Milan only takes a $20,000 taxable distribution and sends the rest out as a qualified charitable distribution. And then we can model both in here, we can see what it looks like if you do that versus just taking the distribution out. Or we can look at it on the larger screen here and say, okay, the only thing we're changing is the fact that one member of this household is taking a $20,000 QCD. So we only have $50,000 of taxable distributions as opposed to the full $70,000 of taxable distributions over here. In doing this, we see a couple of different things happen, right? The fact that the $20,000 that's going out as a QCD never hits the client's income statement means that less of their Social Security in this particular case is taxable, right? Your taxability of Social Security benefits, it's not a flat 85%. It actually is determined by the total amount of income that's on the tax return. So in doing this QCD, not only is this $20,000 not being taxed, but we're also um, not taxing an additional $6,750 of Social Security benefits, so that when we scroll all the way to the bottom and see the combined impact of that $20,000 QCD, if they just did that, would actually save them about almost $5,500 in tax, right? That can be pretty powerful. Now we have some there's kind of a, I don't know if it's a fun disagreement, but when we're thinking about qualified charitable distributions, again, you need to have a deadline. Technically, you could submit one of these on towards the end of the year. As a practitioner, that always scares me, right? Because once you start getting into December, you're in line with everybody else who wants to do the same thing and is trying to do the same thing. And so like there's this mad crowding for the doors. We would encourage folks to try to get this done early so that if there's an issue, it can be corrected. And so that you're not running up against custodians turning things from a guaranteed execution to a best efforts, which will happen sometime in the early part of December. You'll start hearing that from the Schwabs and the Fidelities, like, look, we're going to do the best we can, but we can't guarantee execution if you start submitting things by the end of this date. You also want to coordinate with their total required minimum distribution, because while you can still send a qualified charitable distribution out of an IRA once somebody has satisfied their RMD, you can't retroactively have that QCD count as part of the RMD. So you probably want to have that QCD factored into your total RMD for the year to get the maximum benefit out of doing a QCD. And then the last thing, I don't know how many folks are still doing this, but for a time, and I know there are some folks who use this as a practice, they give their clients checkbooks, both for their taxable accounts and for their IRAs. And they do this for their IRAs for this specific purpose because administratively, it's kind of a pain in the neck to do a QCD for like $100. But if you give your client a checkbook for their IRA, they can theoretically write smaller checks and have them count as QCDs. I say that because there is a school of thought of people that like to do that. To me, it's terrifying and I wouldn't do it. but I know that there are some people who have no problem doing it. But if you are one of those folks who gives your clients checkbooks for their IRAs, you just need to be in good communication with your clients to make sure that you've got the total amount of distributions good to go. And any sort of uncashed checks, you kind of have this running tally of like, okay, here's what they've sent out so that I don't accidentally send out too much and have something not count and things like that. Right. Okay. So that's the QCD side of things. But again, that's only going to work for folks that are 70 and a half or older, right? Because earlier than that, you can't do a QCD. The IRS is kind of weird about this too. It's not the year that you turn 70 and a half. Technically, it's like the day that you turn 70 and a half. So if you don't turn 70 and a half until November and you did a QCD or you tried to do a QCD in like April, technically it doesn't count. I don't know how the IRS is going to catch up on that, but technically this is true, right? You have to be 70 and a half or older to do the QCD. It's not the year you turn 70 and a half. But the thing that applies to those of us who are not quite there would be contributions that we're normally used to, right? Writing a check or sending appreciated securities out of a brokerage account or a checking account to a recipient charity. Um, this has been harder for the last 8 years or so for folks to actually make charitable contributions and get a deduction because the standard deduction is so high, right? So oftentimes you still see charities talk about your gift is tax deductible. Well, that's only kind of sort of true, right? It's only true if you happen to itemize, right? If you send a charity a check for $10,000, but you take the standard deduction, what's the tax deductibility of your gift? Well, it's zero, right? Because you're going to get the standard deduction anyway. You get the same tax break if you donate nothing or if you donate $10,000 if the sum total of your other deductions isn't high enough to exceed the standard deduction. And what's more, the only tax deductible part of your gift is the amount that pushes your total deductions over the threshold for what the standard deduction is. We try to illustrate that with what we call our tax report. So in this case, we've got a sample here. Here's our baseline tax year 2025. They're not doing anything in terms of charitable contributions. And then when we scroll down here on the right-hand side, we've said, okay, these folks, they actually give $5,000 per year. If you've been doing any sort of financial planning over the last 8 years, you've heard of this concept of bunching or bundling your contributions into one singular year. So if these folks are used to giving $5,000 per year, which is what we see on the left-hand side, and at that amount, they're taking the standard deduction because the sum total of their itemized deductions doesn't exceed 31,500. Well, if we say, hey, there's a compelling reason for you to bunch 3 years worth of gifts into this year, you can make a $15,000 contribution, and now all of a sudden you're itemized, right? You've gone over that threshold. I'm going to just show you something here that we can look at kind of to illustrate this point, because I think it's a valid one that not everybody realizes. When we're looking at the tax report on the right-hand side here, this is a Schedule A portion of it. We've stacked the various things that are going into this couple's itemized deductions. We started the things that you have to pay for, right? State and local taxes, mortgage and investment interest expense. And then the top one is kind of like the voluntary one. This is that $15,000 gift to charity. Only the amount that is over this white line threshold where the standard deduction is, that's really the only tax deductible part, right? It's this sum total that pushes them into the itemized category, but it's only the amount that's over the standard deduction line that's truly tax deductible, right? Now, um, that's kind of like the high level bunching strategy. You can extend that further and say, if you don't want to give that all to a particular charity, you can give it maybe to a donor advised fund. We're not going to talk about donor advised funds here, but that's kind of the idea. That is a subset of the bunching strategy where you can gift everything to a donor advised fund and then dole out gifts along the way, but you get your charitable deduction this year. Then two, you can do this comparison of, okay, I normally give 5,000. If I've got the means to do it and the cash flow to do it and all that other stuff, if I triple my gifts for the next 3 years and pull it all into 1 year, that pushes me over the itemized deduction. Notice it's only a $4,000 change though. And the net tax impact, it's something, right? It's $880. Is that enough to give up, 3 years worth of to do that bunching and forego that extra $10,000 that you've now made an irrevocable gift to a donor advised fund or to a charity? Maybe, maybe not. But at least now you've walked through with your client what this could look like and the implication of that. right? One thing to be mindful of, though, as we're thinking about charitable stuff and things that you can be talking to your clients to or thinking about next year, is that in 2026, things change a little bit in two ways. For folks who are itemizing, they now have a little bit of a more of a threshold to jump through or to jump over before things are deductible. So we now have 0.5% of your AGI as a floor for deductible gifts, right? So next year, things are a little less deductible compared to this year. So if you have folks that are on the fence, kind of sort of thinking about donating this year versus next year, if they're itemizing, there's maybe an argument to talk about doing it this year instead of next year because of that 0.5% AGI threshold. There's also next year the ability for people who are not itemizing, who are taking the standard deduction, to still get a charitable deduction, right? So I'm going to bring one of these things into play here, right? I'll actually bring two of these things into play. I'll bring over the one that I talked about first, which is my right-hand scenario here. This is the same thing. It's tax year 2026, and I'm still giving $15,000 to charity. But notice what happens to my charitable deduction here. I don't get a full 15,000, right? Because I have to get over that 0.5% AGI floor, and then it's everything above that that's deductible. So the same contribution this year versus next year has a slightly different deductibility element to it. The second thing would be, again, for those folks who are not itemizing, you can actually take an above the line charitable deduction, just like you were able to do in 2020 and 2021. The only rules are is that it has to be cash. It can't be appreciated stock like some of these other deductions. Okay. Let's talk about the third one. That third one on our spreadsheet, if you remember, was our RMD list, right? So who has to take RMDs by the end of this year? Again, you have to do it. The penalty for not doing it is not nearly as bad as it used to be, but it's still there. So we're going to jump to these folks. These folks do have RMDs that they have to do. We've actually put the RMDs in here. The element of the tax planning process about this is not so much like, are there strategic things that we can do with the RMD? We talked about doing the QCDs as one thing. The most important thing is that they happen, right? They happen before the end of the year. But the other element that you can think about when you're doing RMD planning is how much of that RMD could potentially be withheld for taxes, right? So if somebody hasn't made estimated payments for the whole year and they're no longer doing W-2 or taxes are being withheld over the course of the year, technically they were supposed to be making estimated payments along the way because the IRS wants you to have your tax obligation and what you've paid in to basically be as close to zero as possible. But there are penalties if you don't do it in a timely fashion, right? These quarterly estimated payments. One of the nice things about doing withholding, though, is that withholding is assumed to have happened over the course of the entire year, right? It's not necessarily when the distribution happened. It's as if it was spread out over the entirety of the year. So if you want to move your clients away from needing to make estimated payments and they're in this RMD space, using IRA withholding to cover their entire tax liability, it's really nice, right? You can get away from estimated payments, but you also free your clients of needing to remember, and you, by the way, of needing to remember to remind them to make those quarterly estimated payments in those bizarre IRS quarters, right? That just don't line up with the calendar at all. So, one thing to be mindful of, are we tracking estimated tax payments? Can you cover your full tax bill by using withholding? Again, that's a really nice value add. So those are the things that we want to think about in addition to just making sure that we do an RMD, right? The fourth strategy that we talked about was capital gains harvesting. Um, Backing up a second, we don't see it in here because we only have one person in here. Well, this person has it. If you've uploaded a return to the Holistiplan system and there is a tax carry forward loss, right? So just zooming out a minute. When you take losses, when you realize losses, selling stuff for less than what you paid for it, you can use that loss in a couple of different ways. The first way that most folks are familiar with is that you can use that to offset gains. So if I have $5,000 of losses and $5,000 of gains, poof, they cancel each other out, and it's as if nothing happened. If you have more losses than you do gains, you can use up to $3,000 of that loss to offset other income, potentially more expensive income, right? Ordinary income, as opposed to the capital gains treatment, which is taxed at a slightly lower rate. You can use up to $3,000 of that loss in the current year, and then anything that's left over gets carried forward into the next year where the process repeats, right? So I can use it to offset gains, and then I can use up to $3,000 against other income, and anything that's over gets carried forward into the next year until everything eventually goes to zero or you die, right? So that's nice, right? That's a helpful benefit. one of the things that I would encourage folks to think about is that like losses aren't always as valuable as you think they are, right? A $3,000 loss for somebody in the 10 or the 12% marginal bracket doesn't really do a whole bunch, right? It's nice, it's a little bit, but it's only a couple of $100 off of your taxable income, which, at a 10% rate or a 12% rate probably doesn't move the needle all that much. But one of the nicer things to think about for folks isn't necessarily on the loss side, harvesting losses, but harvesting gains. Why is that? Well, when you are in a lower tax bracket, which is what these folks are, right? This is going to be I think this is the Berg family, right? So we're going to look at, in this case, these folks, yes, they have some wages, they have some losses, right? So we generated this capital loss and all that stuff. But one of the things that can be important when we think about folks that are in lower brackets, and I'm going to pull up the tax report again here, is the fact that when you are in the 10 or the 12% bracket, your capital gains are probably, at least some of them are going to be taxed at a rate of 0%. What does that mean? Well, we're pretty familiar, I would hope at this point, that ordinary income, which is income from, say, salary, taxable interest, IRA distributions, taxable Social Security, all that stuff, pretty much almost everything. That's taxed at progressive marginal rates, right? Where the first bucket in this year for married filing joint folks is taxed at a rate of 10%. Everything above ordinary income that's above 23,850 up to about 96,950, well, that's taxed at a rate of 12%. Then the next bucket's at 22, 24, and so on, right? That's ordinary income, which is most of the income. But long-term capital gains and qualified dividends are actually taxed slightly differently. In this case, for qualified dividends and long-term capital gains, I'm actually going to bring this section up, even though these folks didn't have any with their uploaded return. If your taxable income is such, for 2025, if your taxable income is below $96,700, any element of that taxable income that consisted of long-term capital gains or qualified dividends is taxed at a rate of 0, right? It's free money, at least on the federal side. Maybe the state side charges a little bit more, but at the federal side, it's 0. So as I'm looking at these folks, and I know that this is what we've got set up for 2025, they're going to land in the 12% bracket. Their taxable income is, only $35,500. Am I so geared to realizing losses for these folks, knowing that that loss is only going to shave off about $360, right? $3,000 of losses at a 12% margin rate is only $360. Like, again, that's nice. But on the flip side, if I've got gains, I want to harvest gains because I can harvest a gain at 0%. Even if I don't need the money, right? Even if my client doesn't need the money, I can harvest the gain at 0% and reset my cost basis higher, right? Because with losses, if you sell something and then buy it back right away, that's called a wash sale, and you don't get to claim the loss. But there's no such thing as a wash sale with gain. So if I sell something at a gain today, I can buy it back tomorrow. It's like nothing happened, right? All I've done is I've reset my basis. And again, if my clients are in a taxable income where that element of their long-term capital gain or qualified dividend keeps them below this threshold, then that particular income, that long-term capital gain is going to be taxed at a rate of 0%. Conceptually, what you need to think about if you're thinking about doing this is that we're using a different metric here, right? The metric for this marginal bracket is taxable income, and qualified dividends and long-term capital gains stack on top of ordinary income when we're trying to figure this out. So that's why we illustrate that over here, right? The base of the tree on this side is ordinary income, and then capital gains would stack on top of that, so that you could go all the way up to an additional $96,700 of long-term capital gains and still not pay anything from a federal tax point of view. We have a tool that helps people illustrate that. It's called Range Calc. I'm going to jump to it right now. We're not going to spend a whole bunch of time in there because I promised we wouldn't get super technical. But what Range Calc allows you to do is allows you to visually see the tax impact of adding incremental amounts of income, whether it's ordinary income or capital gains. The reason I want to start here is because what we can see down here, this 0 point, that's my baseline amount of long-term capital gains, which because these folks have a loss, it starts, their baseline amount is minus $21,000. So as I track this from left to right, what I see, there's a little blip right here. This little blip corresponds to I've realized so many gains that I've eaten up my loss. So theoretically, I'm exposing a little bit of ordinary income to these folks' marginal rate, but from a dollar point of view, like I said, it's not that much. But what this is saying is that I can realize upwards of almost $79,000 of additional long-term capital gains right now, and these folks will not pay a dime in federal income tax because their taxable income is going to be below the threshold where that 0% rate for that kind of income kicks in, right? So really powerful, can be really helpful for folks that are lower income, whether that's temporary or, that's kind of where they're at, where maybe they've retired and they're living off of their portfolio. Really nice opportunity to do tax-free income for folks, and you're just resetting that basis for later on. The last thing that we're going to talk about, which happens to be the highest use case that we have inside of Holistiplan, is the Roth conversion side of things. Right now, again, Roth conversions have to be done by December 31st for them to count this year. Um, we're not going to spend so much time on the Holistiplan side of things about all the tools that we have about Roth conversions. That would probably be its own really good webinar. So we're really just going to identify how you might use Holistiplan to do a Roth conversion for somebody at a super high level, kind of walking through our best practices about how you might do that. What I've done on the left-hand side, and I've done this again, assuming I'm using my spreadsheet to identify folks who I think might be good Roth candidates. Who is a good Roth candidate? Well, your mileage may vary, right? We have some folks who only do Roth conversions for folks who are going to be in the 10 and the 12%, maybe the 22% bracket. We have other folks who say, well, I'm going to do a Roth conversion all the way through folks who are going to be at the end of the 24 or the 32% bracket. Holistiplan as a company is agnostic about that. We just want to give you the tools to do the best planning that you can. Um, but what we're going to think about here is maybe we've identified these folks as folks for where the current year, their bracket is such that it's attractive for us to at least think about a Roth conversion. And the question then becomes, well, how much of a conversion do I do? As a best practice, this is what Holistiplan would tell you to do. The first thing is to put your base case together on this left-hand side, this scenario one. This is everything that we know about these folks in terms of their income. These folks happen to be retired, so they're taking Social Security and they've got some investment income, some dividends, some qualified gains, and things like that. We're going to go back to range calc though, right? Because again, range calc is showing us the impact of adding incremental amounts of income to our baseline. So for these folks, rather than looking at the capital gain side of things, we're going to look at the ordinary income side of things because a Roth conversion is ordinary income, right? When we do it, when we take money out of an IRA, whether it's a distribution or it's a Roth conversion, it is going to be considered ordinary income. So again, when I'm looking at the range calc chart right here, remember this zero line does not say $0. This is your baseline amount of ordinary income, which for these folks happens to be $0 because their deductions are so high that it wipes out all of their income. But what you're seeing visually is the impact of adding $1,000 of ordinary income and what the tax impact of that next $1,000 will be. In this case, because their deductions are so high, there's actually an amount of a Roth conversion that these folks can do, upwards of about $15,000, $16,000, where they can basically do a Roth conversion for free, right? Because all they're doing at this point is eating away at the deductions that they already have. For older folks over 65, this year became actually a lot more there's a lot more cushion to do that, especially for folks at the lower income range, because not only do they have the standard deduction and the age 65 element that adds to the standard deduction, but we also now have the enhanced senior deduction of $6,000 per person. Right now, this is not going to be around forever. This is only going to be around for a little bit. But for those of you who work with clients in this demographic, there is an opportunity to maybe do more of this conversion or more income realization at a cheaper cost compared to last year or what will happen 4 years from now. So what this is then showing though is that as I get past that point where my deductions have been wiped away and I start exposing my client's income to taxes, we've got this blue line that's showing you the changes in marginal rates. So let's say hypothetically, I only wanted to do stuff through the 10% bracket. You could find the point on the axis where we jump from 10 to 12%. Look down below at the, I'm going to point, you all can't see this, but I'm pointing right here where it says $38,000. And that's saying at a $38,000 Roth conversion, I'm still keeping my clients in the 10% bracket. If I wanted to go farther, I could, right? I could maybe take folks all the way up to the point where their taxable income still stays low enough so that their capital gains are taxed at zero, right? That would be about an $86,000 conversion. If it was important to me to maximize the amount of ordinary income that these folks had within the 12% bracket. I could theoretically take them to the point where we jump from the 12 to the 22% bracket. But in doing so, and this is where range count becomes super helpful, you are subjecting the capital gains that these folks have from that 0% to the 15% bracket. So that even though you're technically in the 12% bracket for ordinary income, technically you're actually in a combined 27% bracket because you're paying 12% on the Roth conversion amount and then 15% amount on the amount of capital gains that you've pushed out of the 0% bucket and into the 15% bucket. As you go a little bit further, you start phasing out that new enhanced senior deduction. So your actual true rate when you're, even though you're in the 12% bracket, as you're adding more ordinary income with a Roth conversion, you're actually paying a rate of like 30 cents on the dollar. So it's kind of expensive, even though you're only in the 12% bracket. But this is why, and this is a little bit of a commercial where software becomes so valuable and important because trying to keep all these things in your head, I'd say it's borderline impossible, if not absolutely impossible. Maybe you still do a conversion in this zone, but you should at least know that your conversion amount is not going to effectively have a 12% rate impact. It's going to have a 30% rate impact because of, again, ordinary income being taxed at 12, capital gains now being taxed at 15 when they were 0, and phasing out of the enhanced senior deduction, which has the impact of a 3.2% tax increase, right? So, we've done all these three things. We've looked back at our spreadsheet. Again, the concept here was to kind of merge two things, using a Holistiplan system to model how you might do some of these things, but starting from the zoomed out view of how do I identify the people I want to do the work for, zoom in and do the work that I want or need to do, and then communicate that back to the client. Everything that we talked about here, folks can do without being 10-year seasoned tax planning vets, right? These are all things that you can do. You just have to be able to build and be confident in the process that you have about thinking about who you want to do it for, doing the work, communicating out to the client, and then keeping track of all this inside of your CRM for what you did and how you did it. All right. So with that, Sarah, I think there's still time left here for questions.
Yeah, absolutely. We have about four in the Q&A.
Okay.
So to start, Charlie asked, how would you view these tags along with existing CRM tags?
That's a good question, Charlie. So, like, if there are tags that you want to pull out of the Holistiplan system that you have kind of elsewhere, I would just say you have to go through the process of manually adding those tags. It's not challenging to do that. You do have to be a firm admin inside of Holistiplan to do that. But, if I jump to, these folks right here, within the system right here, I can add a tag to it. I've only got one in here, but I could manage my firm tag list. And again, if you have tags inside of a CRM that you want to do and you're a firm admin, you can add them relatively easily. So like, let's just say we want to do the, Roth candidate. So this would be a one-time feature that you would have, one-time work that you would have to do that. But once the tag's in the system, you can then go ahead and apply it to everybody or anybody who would be applicable. All right. Hopefully that answers your question.
Great. The next question from Nathan, does the 0.05 or 0.5% charitable deduction threshold also apply to the donor advised fund contributions?
It does, right? Because a contribution to a donor advised fund, the donor advised fund is the charity, right? It's a 501(c)(3) public charity. So it'd be the same if I'm giving to my Fidelity donor advised fund as if I was giving to the United Way. That 0.5% AGI floor is going to exist for both.
Great. And then the last question that's in the hopper from Lisa, does Holistiplan estimate how much tax the person will have to pay once they do the Roth conversion? If it's a retiree and they have a big tax bill and have to take money from the retirement accounts beyond RMDs to pay the taxes, is it worth it for them?
Great question. So yes, we do, right? So let's say I didn't actually finish my example. So, in this case, maybe I said I want to do a Roth conversion, but not subject any of the taxes to capital gains to the 15% rate. I've modeled that here, right? I've entered a Roth conversion of $85,000. I can actually see in this modal, here's the cost of that conversion. We do that by running the tax bill for this scenario with and without the conversion, since that's the only variable that's changing. We know that if there's a change in the tax, it is due to the conversion itself. And so in this case, it's a $7,800, 78, well, almost $7,900 cost. You can also see that down at the bottom, right? So again, this is why we encourage people to do a base case and then do your variable case. In this case, all we're doing is adding that conversion. And we see that hey, there's a cost of about $7,900 of doing this conversion. How you pay for that, that's kind of different, right? Many folks will encourage you to try to pay for that with after-tax dollars so that you maximize the amount that's actually going into the conversion itself, that's going into the Roth. Um, but we don't go into that level of detail. Now, if the question is, well, how much is that worth it? That's a slightly different conversation, right? Because that's more of a projection as opposed to the current year tax bill. We do have a tool that allows for that. We don't have time to walk into that today, but we do have a Roth projection tool that allows you to model, multiple years worth of conversions to see the long-term impact both on end portfolio value, total taxes paid towards IRMA surcharges and things like that. So the question was, can you show state taxes too? Yes. So you can actually model taxes for any of the states that have a state tax code. So, if I've got, and again, this is state taxes with Holistiplan is part of XYPN's offering. So if you're an XYPN member and you are using Holistiplan, your subscription includes the state tax modeling capabilities. So let's say these folks lived in North Carolina. I could go to add state scenario for both of them, and I can see the impact both of my baseline scenario and then doing the Roth conversion, how much that's going to add to things as well. And I can see that my state tax impact is an additional $3,600 on top of the $7,900 or so that I would have to pay at the federal level.
I lost my Zoom window for a second. All right. I know. Oh man, multitasking. But anywho, that is the end of our webinar. Just to kind of leave some room to talk a little bit about shameless plugs. XYPN, we recently launched our Holistiplan partnership or partnership with Holistiplan. So as XYPN members, we carved out, or as Ben had mentioned, the premium tax planning package is included or is part of the discount. And within that, there is a special tier that we carved out. So up to 15 households is included in your membership. So if you are an XYPN member and not yet a Holistiplan user, then you can sign up for Holistiplan and get those 15 households included in your membership. And then if you're not quite an XYPN member yet, but you're still interested in Holistiplan, then by all means, book a demo. I will drop the link to book the demo in the chat. And then if you're interested in joining membership, which I'm biased, I really enjoy XYPN membership, and I love just being part of XYPN. So schedule a call with our teammates. We can really help you and determine, does XYPN membership actually make sense for you? They're very good about saying, maybe not yet, but we'll work with you just to really make sure that it is the best choice for your firm or for you as an individual. But anyways, thank you, Ben, for taking the time to talk about taxes with us. You make taxes very fun, and I learned a lot about this topic as well. And to all of you, I hope that you have a great rest of your day. Happy holidays if I'm not going to see any of you before Thanksgiving time. And same to you, Ben. Happy
And to you,
holidays
Sarah,
to you.
happy holidays.
All right. Take care, everybody. Bye bye.
Bye.